Hello everyone, welcome to OptionGig. This is your host Vivek, part-time option trader and full-time worker, husband and father. If you also want to generate consistent monthly income trading options while working in your regular day job, then join me in this journey. Hello everyone, thank you for tuning into OptionGig. And in this session, I want to continue the series of option trade management. This is part 2 of option trade management. If you have not seen the part 1 yet, I suggest you go back to previous video and see the part 1 video on how to manage option trades. Alright, why I want to do this? Because option trade management or managing a losing trade is one area of trading which separates the seasoned option trader, which separates the profitable option traders from the novice ones. So it is very important that you know how to manage the trades, because it will happen that the trades will go against you. Once you put on a trade, it's not guaranteed that everything will be working. Everything will be rosy. Trades will go against you, and then you need to know how to manage those trades. All right. So first, let's dive right into it. Why manage trades? Number one, if you manage trades, you can actually convert the losers into winners. Or at least if you're not able to convert them into winners, you will be able to reduce the loss without adding any additional risk. And that's a very important factor. Either you convert your losers into winners or you reduce the loss without adding additional risk. And thirdly, you stay engaged. I talked a lot more in detail about this in the part 1 video, so I will not belabor these points again. So if you have not seen part 1, again, I highly recommend you to go and see the part 1, because in that case, we covered a very basic technique. Now I'm getting into technique number 2, excuse me, of managing the option trades, right? This is the technique number 2. An example I'm taking it, let's say you put on a strangle and now the strangle is challenging you. So the technique that we need to use is you roll up or roll down the untested, i.e. the unchallenged side. For example, let's say if you put on a strangle, and just to recall, strangle means you have a short put and you have a short call above it. Let's say the stock is trading right here. You sell a put below the stock price and you sell a call above the stock price. This is a strangle. Now, if your stock moves down and start to challenge the put, remember your put is here. In that case, what you should do, you should roll down the call. The call was here. You should roll the call down over here. This is how you manage this trade. Going back, this is the stock, this is your put, this is the call. Now if a stock, let's say this was a call, so stock rises up and start to challenge your call, in that case you should roll your put up, because put is the untested side, it is the unchallenged side. So you should roll your put up, and that technique is what? Another second technique for managing a losing trade. Again, we'll see some examples of it in the next slide. So let's bring up the next slide. Let's look at an example of a strangle in my favorite stock ticker XYZ. Let's say stock is trading at 100. You put on a short strangle by selling a $90 put below and $110 call above. Now stock goes down to 90. What you should do in this case is roll down the call which was at 110. Now it has become so far out the money that the 110 call will be sorry, you can buy that call for pennies. So you should close the 110 call, buy that, and roll it down means then you open up a new call, short call at 100. So basically you roll down your call from 110 to 100. That's your defensive trade. And what happens when you do it? You rolling down means you close the 110 call for pennies, and then you opened 100 short call, and the amount of a premium that you will collect when you open 100 short call will be more than the amount of the money you spent to close the 110 call. So net you will get a credit, and that credit which you received will widen your break-even points, and that's what the risk management is. So you have not put any additional capital, but you collected more credit, and more credit means it widens your break-even points. It gives you little more buffer. Let's look at the next example. Same thing, stock is trading at 100, you have a short strangle with 110 call, 90 put. Now in this case the stock goes up to 110. Now it is started to challenge your 110 call, right? The call was at 110, stock is at 110, it's challenging your call. In that case you should roll up your put from 90, bring it to 100. In some cases you can bring it to 100, 105. Again, those nuances we can cover later, but the theme is that you roll up your put from 90 to 100. Same thing, when you roll up your put, you close your $90 put for pennies, and then you collect lot more premium when you sell $100 put, and net you get additional credit. Same concept, get additional credit means you widen your break-even point, you get a little more buffer, same number of contracts, so no additional risk you've added onto your trade, but without adding any additional risks, you collect a little more premium, and which widens your break-even and gives you more chance to be successful. So that's the crux of how you can manage, or how you can do a defensive trade in case your strangle is being challenged. Again, a quick summary: if you have a strangle, means you have a short put, short call. If stock moves down and start to challenge your put, then you should roll the calls down, bring it closer to where the stock is. If the stock moves up and try to challenge your call side, then you should roll the put up closer to where the new stock is. That's it. Whenever you do this, you collect additional premium, which widens your break even, which gives you more buffer, and without any additional risk. So that's the main concept. All right. Again, theory is theory. Like I said, we'll look at a real life example. So let me bring up my platform and a trade from there. All right, so here's, all right, so this is the trade that I want to cover. This is a real life example of a strangle that I did on J&J, which is Johnson & Johnson. Now if you look here, the date on which I opened this strangle was 11/22/2019, and we did a strangle, a very wide strangle, by selling $125 put and $145 call, and I collected $1.49 as a premium. Now let's look at J&J and where was it trading at that time. Remember, 11/22 is when I opened the trade. So this is the J&J chart. If we really look at the chart on 11/22 will be approximately here. So J&J was somewhere here around, let's say, 135, and when we opened the strangle, we opened it at $125 and $145, and our assumption was that J&J can move up or down, does not matter, as long as it stays between 125 and 145 will make money. But who knew that after we put on the trade here, J&J will go just parabolic up. I had no idea where the stock is gonna go. I always say I don't know where the stock is gonna go, but J&J made a huge parabolic move upward. So what we did, so on 18th of December, we rolled up the call from $125, means we closed $125 call put, and we rolled this put to $135, means we closed 125, we opened 135, and we did it on 18th. Why we did it on 18th? Because on 18th the stock was challenging, 18th is around here, the stock was already challenging our short call. Remember, our call was at around 145 and the stock is already at 144, so it was starting to challenge our call side. So what we did, we rolled up the put. So remember, we had a put here, we had a call here at 145, and when we opened the trade, stock was trading here. Now by 18th the stock has actually come over here, it is very close to our call side. So what we did, we rolled up the put from 135 all the way 125 all the way to 135. So we closed 125 and we opened a new short put at 135. By doing this, we collected some additional premium, and when we collected additional premium, it increased our break-even points. So additional premium that we got was 34 cents. So net, if we total it up, the total amount of premium that we received was $1.49 and 34 cents, which is $1.83. And then we got an opportunity on 7th of January to close this new strangle. Now remember, our old strangle, we had a call at 145 and then put at 125. We closed the 125 put here and opened up 135 put. So now our new strangle was 135 put and 145 call, and we were able to close this 135 put and 145 call for 75 cents. We closed it on 7th of January, and let's see where the stock was trading on 7th of January. When we closed it on 7th of January, the stock was trading at around 145, just beyond 145, around 146. So it was already challenging us. It was beyond our initial short strike of 145. But because we have rolled up the put, we have taken additional credit that helped us in widening the break-even point, and the stock was making close to our profit target at this point of a time. If we had not rolled up the put, that wouldn't have been the case. But because we rolled up the put, got additional credit, and then when the stock was around 146, we got an opportunity to close it at our profit target, and we closed the trade at profit target. So this is how you manage a strangle. So we took an example where the stock was challenging the call side. Similarly, if the stock was challenging on the put side, we would have rolled down our call. Same concept. Every time when you get an opportunity to collect additional credit, additional premium without adding any additional risk. So when we rolled the put up, we kept the same number of contract. We only rolled one contract up. So we did not take any additional risk, and without adding any additional risk, you are getting more premium, means you are reducing the overall loss, or you are actually converting the losing trade into profitable trade, which we did in this case. All right, that's all I wanted to cover today. I hope you're able to learn from this real life example. In case if you have any questions, please write it to me at optiongig@gmail.com, or if you're watching it on YouTube, you may leave a comment on the YouTube and I will respond to you. Once again, if you like what you learned, please subscribe to my channel, and also if you're listening it on a podcast, I will love if you can leave a review on the podcast, because that helps others to find this podcast. Thank you very much and happy trading. I'll see you again in our next session. Bye-bye. Please note that all the information presented is purely for educational purposes and is not a financial or investment advice. I don't know you, you don't know me, so do yourself a favor and don't invest or trade solely based on what you hear.